So the reading we're going to be talking about is commodities. Now, it the how the reading is structured is it begins with some very light, very basic stuff about what are the types of commodities, how are they stored, how are they extracted, how are they processed. It is a very light theory, so I would skip that section because the video has just started and your attention level is high right now. So I would want to use this time and work on some concepts that would require a little more attention than those, and then probably towards the end we can circle back towards the theory part. So let's start with commodities futures market. So we talk about who are the participants of the market, which are the major markets, and so there are a number of participants in the commodity future market. First are hedgers. Hedgers can be long on futures or short on futures. So, who are hedgers? Basically, let's say that I am a farmer and I am McDonald's. A farmer knows that he is growing potatoes and has to sell it at the end of the harvest season and needs to hedge the exposure that he has right now. Okay, and McDonald's knows that he needs, let's say, 200 quintal of potatoes the next season. He has to buy it and the prices can go up and he has a risk and he wants to close that exposure by hedging. So let's say the farmer says that I'm going to be selling my potatoes at 100 for a kg. I don't care what the price is at that time. I don't care if the price is higher or the price is lower. I'm going to be selling it to you at 100. And McDonald's says that cool, I'm going to be buying it at 100. So this is a basic hedging contract that can happen. Now, apart from just hedgers, there are traders and investors in the markets. There are exchanges, there are analysts, there are regulators, of course. So we'll talk about them also. Traders. One. So traders and investors. Now, who are these traders and investors? Very simple. Traders and investors are people. Let's say in our previous example, the farmer was not here in the market. The farmer is not organized enough or does not plan enough in the future to hedge his position, so he is not here in the market. But McDonald's, of course, they are a big corporation, they understand the risks and they are in the market. So what's going to happen is that a financial institution is going to enter into contract with McDonald's, and then whatever their gains or losses are going to be, they are going to be a party to it. So traders and investors are there because they understand that not both of the parties of the contracts can be present in the market. They sometimes also arbitrage such opportunities. Let's say that sometime later the farmers actually showed up. Okay, so then they would square off their positions by selling these futures to them. So these are traders and investors. Then other type of people who you will find in the market are just a second. Hmm. Other kind of people who you would find in the market are of course exchanges. Exchanges do what they are to do. Okay. Then regulators, and one very interesting one are analysts. So what are analysts doing there? Analysts can be there for a variety of reasons. Analysts can be there to understand what are the expected prices for a commodity 1 year down the line, 2 years down the line. They might be doing a projection for a to see the profitability of a project they're looking at. They might be wanting to know what is inflation going to look like. They might be government agencies who want this kind of data. So analyst can be anybody who is in the market to look at the market and see what is going to be the trends. So with that being said, we can talk a little about which are the exchanges. There is CME, which is Chicago Mercantile Exchange, which is a very famous exchange. Then there is ICE, which is Intercontinental Exchange, I believe that's what it's called. Yeah, Intercontinental Exchange. Then this just talks about there are exchanges in Brazil which trade grains and livestock. There are in Europe, in London. Then in Asian countries, China has a huge exchange. There is something called Shanghai Future Exchange, Japan's Tokyo Commodity Exchange. So based on whatever commodities are available where and wherever the users are available, these markets are worldwide. Okay, so we talked about analysis. Yeah, so when we were talking about the thing that we should notice is that traders can be of three types. These are informed investors. So basically, they might not have a direct interest in hedging, but they might understand the industry and know that this is somewhere I can profit from. They can be liquidity providers, like we talked, and they can be arbitrageurs, which even look at opportunity in one market and try to even square it off in another market. So they can be present in the market. Then we are going to be talking about spot and future prices. Okay, so very simple. Spot price is what I am being sold, let's say the commodity for today. Let's say I want to buy 1 kg of corn and the price is 100 rupees today, and the future price 3 months down the line is 80 rupees. Okay, so the market is in backwardation. That is, if I am buying something 3 months later, my prices are lesser. And had it been the other way, that the future was 120, the market would have been in contango. Okay, and now one thing to note is that spot prices can be very specific to where we are, what is the commodity. Let's say the same commodity in Brazil and in India might be very different rates because of where they are being produced, what is the quality, and stuff like that. But futures are generally more I would say standardized because they are listed on exchanges, and they are basically worldwide prices, and you don't really have to have the stock of something to be able to buy a future. You can just have a cash settlement done too. So these are some of the things that related to spot and future prices. Now one thing is basis. Basis is the difference between spot and future prices. Now alright, so now there are some theories of future returns. The first is insurance theory, where Keynes has said that the markets are there is a normal backwardation in markets. The markets would normally be in backwardation. Why? Because when somebody is buying a future from you, they are giving you an insurance that at this point in future I'm going to buy your commodity for this price. Okay, so they are giving you a promise, and they are helping you hedge your position today. So in return of that, they need a little bit of premium, and that premium is what makes the future price to be lower than the spot price. Okay, and the markets would normally be in backwardation, and this is what his theory is. But it was refuted, and said that this is not how things work. So things actually have a hedging pressure. So some new people came up with this thing called some new people came up with this thing called hedging pressure theory. Hedging pressure theory says that hmm, so one thing to be kept in mind before I go to hedging pressure is that Keynes was assuming that the market is dominated by producers. So producers want to cover their positions, which is why they are in the market. Whoever is buying the futures are just financial institutions who are helping them cover this for a slight premium. Now, hedging pressure theory says the opposite. It says that market is not dominated by producers. It has both producers and both producers and buyers in the market. So, if something, let's say that the number of producers for something are higher than the number of buyers, then of course it's going to be in backwardation. If the other way around, the buyers are more, producers are less, then the spot price is going to be lower than the future. The market is going to be in contango. Okay, now there are a few flaws of this whole theory, and that is that producers generally have slight more exposure than buyers. Why I say that is because, let's say I'm talking about the farmer and McDonald's. Now McDonald's can, at times work their way around, and one thing is that potatoes is, let's say, 2% of the costs of what all goes into their products, and let's say they have the power to even change what their recipes are like, and maybe instead of potatoes, they reduce the percentage of potatoes and increase onions, or increase something carby that makes it still taste like potato. So buyer generally has a little lesser exposure than a seller. A farmer who has grown potatoes has to hedge it, has to sell it. So these guys have a little more exposure than these guys. And there was another one which was like a drawback of hedging pressure. Just give me a second, I'll go through. Oh yeah, so the second one was it's not just producers and buyers who are sitting in the market. With the advent of newer markets and more people coming into the markets, the corporate treasury departments of the corporations, they are sitting in the market, and they are actually now also want to draw some profit for the company. They are a profit center, and they want to get some profit built for the company, and which is why even they are speculating in the market. So this kind of negates the whole theory of the number of producers and the number of suppliers, the number of buyers is how the prices would be determined. Now the next theory is theory of storage. Now theory of storage says a very simple thing, that there is something called convenience yield, which is basically the benefit you get from storing a commodity. Now, very simple thing is, if your cost to store is more than your convenience yield, that is the benefit that you get from storing is, then of course the markets are going to be in contango, right? If you want it today, take it for cheaper, because my cost to store would be so high and my benefit would be so low, so I'm going to be selling at a higher price. On the other hand, if cost to store is less than the convenience yield, just a second. Yeah, if it's less than the convenience yield, then of course the markets would be in backwardation. One way to look at convenience yield is also that how curriculum looks at it is how much of the commodity is easily available. And so let's say in case of wheat, you know, kind of easily storable, available at every next shop, and in my neighborhood also I can find 10 different shops which will have wheat or flour, and even people store it in their houses. The cost to store is also low and it's easily available everywhere, so the convenience yield in this case is very less. Okay, if somebody is hoarding on wheat, their benefit would be very less. But let's say we are talking about something more not easily available, and let's say avocados, right? So I don't know about other countries, but in India it's very rare to find an avocado, and it has to be stored in a very certain way at very certain temperatures, or they go bad. They don't even grow here, they need to be imported. So of course the convenience yield for this is high. If somebody needs an avocado, they're going to go lengths and pay a higher price for this. So that is also how they talk about convenience yield in the curriculum. So one thing that they say in curriculum is that future prices are nothing but future value of spot price plus future value of storage cost that I'm incurring today minus future value of convenience yield. So if the convenience yield is high, my future price is going to be low. If the convenience yield is low, my future price is going to be high. Okay, one very nice example is that when civil war broke out in Libya, what they did was, this was the spot price, this was the future price. The price of oil was really high, so what they realized was that this is what my price is today. This is long term. This is into future. By then, I'll figure out something about my problem, and I'll have it again for lesser. So markets were in backwardation because people assume that in some time things are going to be fine. Okay, what we're going to read about is components of future returns. So we'll look at an example. This is my price, spot price 100 today. This is my F2, I would call it, which is after a month. So that is what 80. Okay. Now my spot price fluctuated throughout the month, and after a month, my spot price was exactly 100 again. My future price now was 80. Okay. Then again, we went on the journey for 1 month. My spot price ended at 100. My future price ended at a 70. Let's call this one mm, 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 110. Okay. And my future price is 70. So I need to calculate how much was my earning here and here. Okay, so here, how much was my earning? Look at this. I had something for 100 bucks. Like I sold something for 100 bucks and I bought the same thing for 80. So already I made a roll yield of 20. Now because the spot is same as the last period, my price yield was 0. Collateral whatever was the RFR, that is what I made. Now here I had something worth 110. I got the same thing. I sold that, got the same thing for 70. So my roll yield is 40. My price yield, my price has gone up 10. So my price yield is 10 and whatever is the RFR. So the logic behind this RFR is that whatever the collateral or margin that you are posting, you won't post it in terms of pure cash or something like that. You will post it in treasury bonds or something that would provide you risk-free return, and which is why you'll earn that amount as well. Next topic is commodity swaps. What are the kinds of swaps that we have? We will have to check. Yeah, so there is a total return swap. Then we had something called excess return or something. I saw that. Again, here there is a basis swap. There is a variance swap, also called as volatility. Oh no, this is different. Yeah, so the five types we are looking at is total return, excess return, basis, variance, volatility. Okay. Now we're going to work on very specific examples for each of them so that it's like burnt into our memory. Okay, so the example of total return swap is this. Let's say in month 1 the price was 95, month 2, month 3, month 4, month 5. So what happened was swap holder lost 5 rupees here, $5 here, and the dealer won $5, the opposite. Then the same with 10, and so on. So this is on total return. Whether it is a loss or a profit, it's considered as the risk of the swap holder and dealer equally. This is what a excess return swap looks like. So in the beginning, the holder already gives $25 for covering, let's say, the next 5 months. The dealer receives that $25. Then this is what the price was at the end of 5 months. So when it was below 100, the dealer did not had to pay anything to the swap holder, but when it was above, he had to give the money to the swap holder. To understand this example, you can take it as let's say this is fuel price that a transport company, a logistics company needs to stabilize or hedge. So in this month, when the fuel prices went up by 2 rupees, these people got this 2 back from the dealer, which is what kept their price constant. Okay, so a very delicate topic. I would really want you to listen very closely. It took me a while to build this concept, and I'm sure it will take a while for you to build this concept. So, what we're trying to explain is what is a basis swap and why is it even required, and what is the real practical use of this. Okay, ignore this part of the page. I had built this example and I'm keeping it for myself so that if I forget something, I have it to refer back. So, you look at the fresh part of the page, please. So, what I'm trying to say here is I am a bakery. It's a very simple example. I am not saying that this would occur, but I'm sure you would be able to extrapolate it to other industries. So, what I'm telling here is I am a bakery who wants to hedge my price for wheat. I want that I keep buying wheat for $100 in all the months. So, what I basically want is a future. But what happens is that this is not available on the futures market. Although rice future is available, okay, they say that future price for rice is 80 rupees. I can buy rice for 80 rupees, all right. So, what I think is it's okay, even if the wheat future is not available, this is what I want. It's not available, fine. We have the rice future, and that is what we're going to be doing. So, um, what we do is we buy the rice futures and we do some financial engineering in a way that I'm going to be paying $80 every month. That is what I'm going to be doing for wheat. So, these are the spot prices for rice and wheat in the coming months. Okay, let's just make up the prices. The rice was, let's say, 90 rupees, 80 rupees, 110, 100, and probably 80. Okay, wheat was 110, 120, 130, 100, and 140. Okay, so now you're going to be getting two sets of payments. One is the cash settlement for your future. It can be positive number or a negative number. First, look at this. You own this future. At this month, the rice is available for 80. You have a promise to buy it for rice is available for 90. You have a promise to buy it for 80. So of course, you get a cash settlement of $10. This month, you do not get anything in a cash settlement. This month, you get plus 30. This month, you get plus 20, and this month again, you get nothing. Okay, so actually, for the sake of experiment, let's put this as 70 so that we have at least one example that has a minus. Okay, so this month you're supposed to give back $10. Now another payment that you would be receiving is from the swap. Okay, now what swap do you have is basis for these two, which is that the difference between these two would be paid out to you. So what is the difference between these two? The difference between these two is 20. I'm sorry, it's $20. Then the difference between these two is $40. These two is 40 again. These two is 0, and these two is 70. Okay, so what is your net profit and loss in this situation? And 60. Okay, now this is where the magic happens. Now you want to go buy the wheat with this price. Okay, and this is the original price that the wheat is available at. We had promised that you are going to get wheat for $80 no matter what. Let's see if it's happening or not. Okay, so I go buy wheat for 110, I go buy wheat for 120, I go buy wheat for 130, I go buy wheat for 100 and 140. So what is happening is, in the end, no matter what, I am paying $80 for it, right? This one actually has some problem. Let me check what's happening here. Oh, this should have been 20. So 50 and 80. Yeah. So in the end, I'm paying $80 for my wheat. Do not consider this a magic, because the wheat was because I actually wanted to hedge it for 100, but I'm getting it for 80. I would have paid something, some kind of premium to even buy that swap, right? So what it has done is it's letting me hedge, but pegging it to another commodity. We have pegged it to rice, and in the end, we have hedged it. We have hedged something that was not available on the futures market.